The question I'm being asked is, have you ever used the Awesome Oscillator and is it any good? And do you know how it works? Yes, I have used the Awesome Oscillator and I know exactly how that works. So let's take a look at that. Let's get rid of all of this. We'll get a blank chart. I'm going to show you how the Awesome Oscillator works, and I'm going to show you a system that you can use that uses just the Awesome Oscillator. It's a nice tool, but we can make it better. And we're going to make it into the Awesomer Oscillator. So the first thing I'm going to do is put the Awesome Oscillator on the chart. Now, indicators, we'll go to technicals, might actually be here in the list. Awesome Oscillator. Great, so that was quick. All right, we've got the Awesome Oscillator. Now, the Awesome Oscillator is a price oscillator. Now, when you click on the Awesome Oscillator, it doesn't matter what program you use. Generally, there are no settings. You can't put in or change the inputs. It is some kind of trade secret. But I'm going to tell you exactly what that trade secret is. The Awesome Oscillator, again, is a price oscillator. So what it's looking at is two moving averages. It's looking at the 5 SMA and it's looking at the 34 SMA. And this essentially is the crossover indicator for the 5 simple moving average and the 34 simple moving average. Now, there's one key feature that most people, if they know what the settings are, still don't get right. They're not moving averages of the close. They're moving averages of the median price. So what I'll do is I'll add my own price oscillator and we'll compare the two, see if I'm right. This is my price oscillator, and what a price oscillator does is it just shows the differences between two different moving averages. So I'm going to change mine. SMA, we'll make it a 5 period. Now by default, most oscillators use the close price, but we're going to use the median price. And again, SMA, we'll go 34, and not the close price, but the median price. And if everything is right, these two oscillators should be identical. And by the looks of it, everything looks good. Let's just change the colors really quick. We'll make this one green and we'll make this one red, just so that we have the same look for this. All right, so this looks like we have all the right bars in all the right places. So it's a 5, 34 simple moving averages of the median price. Now, the way it's designed is if these bars end up moving up or the bar price is higher than the previous bar, it'll be a color. And in this case, it's green. And if the bar is lower than the previous bar, it'll be a different color. It'll be red. Now, the way the Awesome Oscillator is supposed to work is you get a trend. So you've got this Awesome Oscillator on one side. And from there, we're looking for the Awesome Oscillator to change colors and then change back again. So what we've got in this area right in here, we've got the Awesome Oscillator moving down. So we have it underneath that 0 level. And then we're looking for a pullback. So we see that as it changes color in here. And then we place a trade as the color goes back into that trending direction. So we get this market move down, this pullback. And in here, we get the color change back into that downward trending direction. And that is when we take a short trade. And we could do that again in here somewhere and in here somewhere. So we're looking at that Awesome Oscillator changing colors into the trending direction. Now, with the Awesome Oscillator, we're going to find that often it's going to be a little bit late. In order for you to better see this, and in order for us to actually trade the Awesome Oscillator well, I'm going to put those moving averages on the chart. Now, again, they're going to be simple moving averages. Now I've got a moving average indicator. I'm going to change the inputs for the first one to an SMA. It's going to be a 5 and it will be median. So the next one is going to be 34, which I already have as default, and also median. And we'll hit OK. So this first one I'm going to make red. Style red. All right, so now we can see this. Now, this is what the Awesome Oscillator looks at. It's looking at these two moving averages. We can see when we get a crossover to the upside, the Awesome Oscillator crosses up. When there's a big gap between the two moving averages, the Awesome Oscillator is very tall. When the moving averages come together, the Awesome Oscillator gets very short. And again, when it crosses to the downside, that Awesome Oscillator also crosses to the downside. Now, if we take a look at anywhere on here, what we're looking at is the Awesome Oscillator's signals. We want to see that we are getting into short trades when the trend is down. And in this case, the 5 underneath the 34 is a downtrend and the 5 above the 34 is an uptrend. So we're looking for short trades when the trend is down. We're looking for long trades when the trend is up. And the way we find those trades is by looking at this awesome oscillator. And what it's doing is it's looking at the distance between these moving averages. So when these moving averages start to squeeze together a little bit, we're going to see that these bars are green on the awesome oscillator. When they start to separate a little bit, we're going to see that they turn red. And that is going to trigger awesome oscillator signals. Now, if I draw some lines on this, let's see, we have a signal to the short side here, which is this one. Now, if we look at that, I'll draw that one on the awesome oscillator as well. So we've got that vertical line here. This is not a bad entry, but it's not ideal. We can make this a little bit better. And let's take a look at another one. So we've got signal to go short in here. Let's put that on the price and on the oscillator. So this becomes the signal to go short. Now, there's nothing wrong with these signals. They are what I would consider to be a little bit late. So maybe there's a way that we can improve that. Now, we're not going to be able to improve it with the oscillator itself, but we can improve it by using the moving averages that we have on the chart. So let's take a look at this just with the crosshair. So we could see on this one candle here, this would be the entry to go short. But the awesome oscillator doesn't give us that entry yet. It's the next candle. Now, this next candle is little, so it's not a big deal that we get in on this candle or the previous candle. But sometimes that is not going to be the case. So let's take a look at some other opportunities. We have an awesome oscillator long in here and another one in here. With the crosshair, we can see how it goes up. This one would be the long. This one is not too bad. This next one would be the long. This one I would consider to be a little bit late. Now, the awesome oscillator will give you decent signals, but again, I find that these signals are a little bit late. So let's take a look at a way at making the awesome oscillator awesomer. So we're going to be looking at the price action versus the zone. Now, the zone is this space between the 5 and the 34. We're looking for the price to enter the zone and then close outside of the zone in the trending direction. So in this instance right here, we have the price getting into the zone and then closing above the zone or on the trending side of that 5 SMA. So this becomes the signal to go long. This candle right here is our long signal. So we'd place an order just above the high of that candle. Stop loss goes just below the swing low. And then we'd be going for 1-to-1 or 2-to-1 or whatever your target would be. So this would be an ideal entry. Now, if we look at this as the ideal entry, and I get my crosshairs out once again, we'll see that this entry hasn't triggered yet on the awesome oscillator. It's not until 2 candles later where we get that actual signal to go long. If we wait for the awesome oscillator to trigger a trade, there's going to be times where we're getting in at the end of a market move as opposed to the beginning of a market move. So let's get rid of those. Let's take a look at a couple more examples. I think here most traders would agree that this big bullish engulfing candle would be the signal that you'd want to take to go long. Now, the awesome oscillator has not turned yet. It is still red. Instead, it triggers on the next candle. We'd be looking at an entry just above our signal candle as the price climbs out of the zone. And again, our stop loss just under the swing low, and then we're seeing the market move. All right, so let's zoom out, take a look at a couple more. Now, what I want to mention is something called a convergence. We've been calling it the moving average squeeze. When you have a convergence, you have 2 moving averages coming together. They diverge and they converge. And you know this in the MACD. This is the foundation of the MACD indicator. It's a moving average convergence divergence. And that's typically how we want to trade if we're using these different moving averages. We're looking for the moving averages to converge. And then as the trade happens, the market is going to pull those moving averages apart. So the ideal entries is during a moving average squeeze. So we'll take a look at a couple of really nice examples of the moving average squeeze. So we've got one right here. This would be a beautiful example of a moving average squeeze or a convergence. So we've got the price moving down, it pulls back up, the trend is down, we've got the market getting into the zone and then closing outside below the zone during that moving average squeeze. So now our short would be underneath this candle right here. This would be our signal candle, stop loss just above that swing high. And then the market ends up moving down and we have a profitable trade out of this. And this is using nothing more than that awesome oscillator. We're doing this a little bit differently. We have to have the moving averages on our charts in order to make this work exactly the way we want it to. We're looking at the pullback, we're looking at the moving average squeeze, we're looking at the close into the trending direction outside of those moving averages, and then we're looking for the trade. This is a nice example of why I like to place my entry orders above or below the actual candle. In this case, we get a signal to go long, but this isn't a signal that'll get us into the trade simply because the entry would be above the high of that entry candle. The market never comes up to tag that entry. Stop loss down here, entry up here, target 1-to-1, previous highs is good, target 2-to-1. Even though we get that signal, we don't get entered into the trade. This would have ended up being a losing trade if we took this trade at market. Once that candle closes and we take this trade, we could get into possibly a losing trade and we'd be giving some of our money back to the market. Now, we want to avoid that as much as possible. It's not always going to be something you can avoid, but by entering trades this way, it is something that you could limit a little bit. So when I'm looking at the signals, I'm looking for the moving averages to be together or at least have squeezed together. So when I see signals that are something like this, when I see a signal that is up in this area here, I am not super keen on taking this trade because we've got this space in between these moving averages. We've got this big gap. When you have a big gap between the 5 and this 34, we would consider this market to be overextended. We're looking for the market to pull back, get that moving average squeeze, and then we'd be looking for that trade opportunity. Same thing would happen in here. What we're looking at is a big gap in between these moving averages. So at this point, if I'm looking at these moving averages, I'm seeing that we've got a little gap in here. We've got this nice moving average squeeze. The short is beautiful on this trade. We get this beautiful short trade. The moving averages separate and then they separate even more. So if I get a signal anywhere in this area, I am not interested in taking a trade. Now, this is a really nice example right here. We have this big move. The market moves down and it separates these moving averages. And with this huge separation, we get a really tall histogram. The Awesome Oscillator is really separated. It's really big. So when we start getting signals after these really big market moves and this Awesome Oscillator is very tall, we want to avoid all of those signals. We're in an overextended market right now, and taking any trade down here would be very dangerous. It'd be very risky. So the Awesome Oscillator is a really nice tool. We can take advantage of this Awesome Oscillator's moving averages. But if you're going to trade the Awesome Oscillator, I would like to make this the Awesomer Oscillator by using the moving averages on the chart and then look for trading opportunities by using those moving averages. All right, I hope this is going to be a valuable tool to you. Try it out, see what you think, and let me know.